Now, we've all been watching the summer rally in risk appetite, and so two of the proxy markets that you could use just to illustrate that rise in optimism ever since the month of June is, of course, the S&P 500 and Eurodollar. And you can see the S&P 500 there on the left side, rising to new highs last seen since the 2008, which I'll show a chart on that in a second. And Eurodollar certainly having this very strong bounce back from very oversold levels, reaching up into that 130 psychological handle on Eurodollar. And certainly these two markets, S&P 500 and Eurodollar, are regularly seen as potential risk-related trades. Now, we have a week full of busy event risk, and today we have the ECB policy meeting confirming basically solutions to the peripheral risk out there in the market. How the market will react, we'll see later on today, but also for the rest of the week. So ECB is definitely an important event that is taking place today. Quantitative easing. This is a nice humorous cartoon that I've pulled out ahead of the Fed meeting tomorrow, where they'll be deciding whether there'll be another bout of quantitative easing. Now, this cartoon is a ship actually illustrating quantitative easing coming out of the UK a while ago, but it's a ship just saying, what are you doing now? And just put any government in charge there. Set course for quantitative easing. So you can see there they're on the cliff edge, the fiscal cliff, we could say, of the US fiscal cliff. And this kind of constant printing of money or quantitative easing is still deemed as the solution. But of course the question is for how long. So we need to ask ourselves, A, is there going to be further bout of quantitative easing? But B, we also need to keep in mind that each time there is quantitative easing coming out of each of the Western governments, but specifically the US, that each time there is a diminished effect. And this is what the cartoon is pretty much trying to illustrate, that we are on this fiscal cliff, and no amount of quantitative easing is really going to solve the situation. It'll only avoid the situation in the near future, just prolong the agony until we actually feel the pain later on. So that's quantitative easing scheduled for tomorrow, where we actually find out whether there will be quantitative easing or not. And then finally, more information about the new Apple iPhone 5. Why am I showing this to you? Because, of course, Apple is at record highs near around the $700 mark, and certainly Apple by itself is a juggernaut stock worth over 15% of the US stock market index. And so it is very much one of the mega cap stocks that is leading the rise higher in this risk-on phase in Western equity markets. But also, Apple is a key economic indicator. Okay. So that's just the event risk. Remember, I've just said ECB meeting, quantitative easing, announcement for tomorrow from the Federal Reserve, and then the new Apple iPhone, a key gauge for economic movements, and of course the stock markets, because the Apple is such a large weighting in the stock market. Now, moving on quickly, everyone is talking about the U.S. stock markets making new highs, and certainly the S&P 500, the broad capitalized stock market, is an example of that. But keep in mind that the S&P 500 is still pressured by 2008 crisis levels, roughly at 1440, if you want a price level for the gauge, for the index. And the key point here is that the market has a memory. Just like human beings have a memory, the market has a memory. And this memory is more of a negative memory that is likely to create pressure for the market. So we might push above 1440 for the short term, but my personal belief, my professional belief, is that this is an unsustainable move, partly because of these 2008 crisis levels that we are now pushing up against. Remember that point I made about Apple? Certainly, the Apple stock price has been rising, as I like to say, irrationally, and there's been a huge performance year to date of well above 50%. And here we can see potential renewed exhaustion beneath that psychological $700 handle. Now, for those of you that might be invested in Apple for this year or even years before, I mean, first of all, congratulations on making fantastic profits in that stock alone. All I'm saying here is that you need to be a bit risk averse, maybe have a trailing stop, maybe reduce the position size. Just be aware that maybe adding to your Apple position at this moment in time might not be the best thing to do. Wait for new highs to add to that position if you really want to get more heavier, be more of a heavier buyer in Apple. But I would just be more aware of the downside risks than the upside potential, given that Apple has risen so much in such a short space of time. And look at the spread, the difference between between Apple's share price and the long-term moving average. It's been well above that for a long time, and you wouldn't sell just because of that, but it would still keep you risk averse. Just keeping in mind the massive outperformance from that long-term average, and just generally the irrational rise that we've seen so far. Second point I'll make is keep in mind that Apple is not just a stock. It is a mega cap company worth trillions of dollars that is very much an economic indicator for the US market and will have a domino effect on many portfolios, many funds out there that own this stock. So this will be an indication as to potential corrections coming in the next 2 months if we do see it. Now, one of the points here that I want to make is that there's a number of non-confirmations of the rise in the equity markets, and the point about Apple that I made is that that it might be a little overbought at the moment, but also that it's only the large mega cap stocks that are really rising to new highs. The broad stock market is not confirming the S&P 500 moves and various other new highs that we're seeing. And so one of those key classic examples, the Dow Transport Index, which is showing clear divergence for the entire year. And although we are seeing a little bit of a bounce back within that range in the last few weeks, there is still a classic Dow Transport non-confirmation with the Dow Jones Index, and of course with all the other major indices. The key message here is this is telling you that basically the economic growth that is potentially being seen by the local stock markets making new highs is not being facilitated across the country, the US. But you can also, of course, use this as a global indication of that divergence. And I also use other transportation-related indices such as the Baltic Dry Index and various other proxies to also give a message about that, about the divergence of some of the growth stocks versus some of the transportation indices.